Right. Who wants to have some fun? Woo! Does anyone want to have fun? All right, we're going to talk about the second most fun thing you can do in the world, and that's invest in Bitcoin companies, right? Or any type of early stage, technology investing. Okay, so hopefully we have some slides coming up here. So if you are a builder or a founder, or maybe you were an early employee at a company and you're sitting on some equity, or maybe you wanted to learn something about investing in companies, hopefully there's something here that you will find useful. So do I hit this button here? Yep. I hit the button, and all right. Okay. We're not talking about bips. We're not talking about bolts. We're not talking about splicing, okay? All right. Okay, so the way that I look at this, or I look at what we're doing, is we are a routing node for venture capital, okay? We're a routing node. Basically, we're a node and we're opening channels with founders, okay? We open a channel with the founder, we make an investment, and then we slave tirelessly to support that company and everything that they want to do. So that's the way that you can look at us. Obviously, we just invest in Bitcoin companies. And what's cool about where we're at now with Bitcoin companies is there's many different types of Bitcoin companies, right? Before you pretty much just had exchanges and they're selling everything. But here's a few. We put a few up here that we've invested in. And, there's wallets still. There's like a Blockstream, like a Cisco Systems for Bitcoin. There's Scarcity, they're in NFTs and artwork. There's Swan Bitcoin, of course. There's Thunder, they're in the gaming space. Voltage is nodes. Crowd Health is actually a healthcare company that adopted Bitcoin, and they're doing very well. So there's a lot of cool stuff you can invest in the Bitcoin space. It's a lot different than before. Okay, let's do a quick PSA. Let's get this out of the way. First things first, investing in Bitcoin companies is not a substitute for buying Bitcoin, okay? And when in doubt, remember, ass first. Always stack sats, okay? Jump in ass first, guys. You're going to be buying Bitcoin the rest of your life. That's never going to go away. This is a way to complement your HODL position and get some different exposure. Plus, it's super fun. We're going to get into that in a second. All right, so you don't want to sell a meaningful amount of Bitcoin to invest in Bitcoin companies. And we're going to talk about the price of Bitcoin companies versus Bitcoin over certain time periods and how it can actually outperform, okay? So just like hodling, you have a low time preference, okay? And that's required for all angel investing and early stage investing. Okay. Who am I, right? My notes for this slide, except I can't see them, is keep it short, no one cares. I was in the music business for about 10 years. I'm a late 2012 Bitcoiner. I've invested in over 1,500 companies. That's outside of Bitcoin, and we're going to talk about how that's even possible. And my company is Lightning Ventures, and that's what we're focused on now is just Bitcoin companies. Okay, I love this meme here. I'm not sure if everyone thinks this is as funny as I do. But what this says here is the angel investor who wrote a 1K check monitoring every move you make as a founder, okay? And that's because you can get into a lot of these things for $1,000, right? $1,000 minimum investment. And that's great. That's great for learning. You don't want to come into angel investing with 2 big checks, okay? You want to learn from experience, and a lot of things can happen, okay? They call it spray and pray. I don't like that term, spray and pray, but you definitely don't want to just invest in a small amount of companies. You definitely want to have a lot. Okay, so for the builders out there, well, you can't spell funding without fun. That's for sure. All right, so let's go over a couple of things. So what do you do, all right? Well, you got Alice and Bob, they want to start a company. They got to incorporate, right? And you don't want to have an LLC. In America, we have a limited liability company. That's not something that you want to have. In fact, a lot of venture capitalists can't even invest in LLCs because they're prohibited from that. Okay, so yeah, Delaware C Corps, right? Because it allows you to issue different levels of stock. You have a Series A, a B, a C, so on, and there's different kinds of rights, okay, and different sort of provisions in each one of these along the way. You also have no K-1s that you have to deal with, employee stock options, and a lot of different things that you have to do. Okay, so put together all your materials in advance, right? Get a Google Drive, get your cap table in there, get your deck, get whatever you have. Maybe you have a short executive summary, something on the team. Have that ready, right? So when you approach a VC or someone about potentially making an investment, that they can just easily do their own due diligence and see what you're doing. 10 to 15 slides on a deck. You don't want like a 40-page deck for your company. And then, of course, you got to learn how to pitch that, right? I mean, we do some calls with founders, and 30 minutes in, I still don't actually even know what the hell they're doing, okay? And that is a reality. Okay, and then understand your capital needs, right? Think about who you're actually talking to. If you're talking to a late-stage Series B investor, and you're raising your first round, you're probably wasting everyone's time. Same thing with, you know, if you're raising for your Bitcoin company, you shouldn't have to be explaining Bitcoin to VCs. That'll be about half of the call right there. It's just actually explaining Bitcoin, which you used to have to do before we had such a kind of robust industry here. So, all right, so just gonna touch on a couple of things here. So like an options pool, right? We have Alice and Bob. They start a company. They used to date, but that's way in the past. Now they're moving on behind that. And it's a 50-50, right? 50-50. And then they take an investment from VC1. And VC1 buys 10% of the company. So now Alice and Bob have 45%. VC1 has 10%. And then they take all that money from VC1 and they go to make their first few hires. But where do the options come from? Where does the equity come from that goes to these new hires, right? They didn't create an options pool. So now they have to do that after, and then what happens? That VC who just invested, he's now getting diluted because there wasn't an options pool, okay? These are some things that people don't really think about when they're starting their company. At the same time, maybe they created an options pool beforehand, right? Maybe there's 45%, 45%, and 10%, and then they take an investment, and the options pool is diluted at the same time. So the options pool gets continually replenished with every subsequent funding round, okay? All right, take the lead. What's a lead investor? You hear it all the time, right? Oh man, we gotta find a lead, we gotta find a lead. We're circling leads. What's a lead investor? Well, it might be the biggest check in a round. It might be the largest investor. It might be an investor that has a certain amount of cachet to it, right? It could be a big fancy name. It could be the person who sets the terms, right? Maybe he didn't have the largest check in the round, but maybe he's the one who negotiated the terms. So it can mean a lot of different things to have a lead. And the reason why I love venture capital and this world of investing is it never gets old. There's so many things to learn from founder makeup. Is one founder better than 3 founders? Is 2 the magic number? Is it 1 founder, but he must be technical? You know, some VCs, if it's a solo founder, he has to be technical or they won't invest. Is it better if they worked before at their previous company? Is it better if they're siblings? I love investing in siblings as founders, right? Because when you talk about dispute resolution, they've been fighting over the toy since they were like, you know, born. Okay, so it makes it makes it easier when you think about all these different things that go into it. You know, Harvard put out a study. Take that for what it is. Harvard put out a study that 65% of startups fail due to the conflict resolution, due to the teams. Okay, not due to not being able to raise a round, not failing because of fundraising or failing because of not finding product market fit. Okay, so we're going to go pretty quick here. These are just a few things that you will learn when you start going through the boring world of venture capital that we're trying to make very fun for the next half hour. Okay, we have safe notes, we have warrants, we have liquidation preferences. Oh, God, that sounds terrible. What is that? Dilution and KPIs and most favored nations clauses. It sounds like very governmental, you know? But these are all things that you learned, right? And when you're a founder, you just want to get down and build. You just want to build. You don't want to be worrying about your TAM, okay? But these are all things that you learn as you get going, and we're just chatting about it. Okay, so we're ready to play. What are we going to do? Let's pick a player, all right? Let's go through the landscape here, all right? So venture capitalist, okay? VCs come in a lot of different shapes and sizes, okay? If you're like a Star Wars fan, or maybe Lord of the Rings, you know, you have trolls and demons and all these kind of different little characters, certainly a lot of trolls. And when you have VCs, you have micro VCs, kind of small VCs like myself. You have large VCs. There's all different kinds, okay? And what VCs do is they take money from limited partners, right? They call LPs, and that's what they deploy, okay? So that's kind of the flywheel. The LPs have to give a bunch of money to a VC. The VCs have to invest that money in founders. Hopefully they're great stewards of that capital. They have to give more money back to the LPs, and that keeps going, okay? And if it doesn't happen, you get something like we have right now, which is like a frozen IPO market and SVB Bank collapsing, right? Because when times are good and everyone in these companies are raising and raising capital and they are depositing it in SVB Bank, that allows this to happen. But then once that stops, the music stops, okay? And that's why we Bitcoin. Okay, next up, angel investors, right? These are people acting on their own behalf. Maybe they are previous founders with exits. Maybe they're tech entrepreneurs. Maybe it's something they dabble with. Maybe they're high net worth individuals. So what they're doing is they are investing their own money into companies, right, on their own behalf. Sometimes small checks, sometimes large checks. And then we have scouts and advisors, okay? So scouts and advisors, like Jimmy, who is not here. Jimmy hates VCs. I really want to do a debate with him. So scouts and advisors, right? They're not investing money in these companies, but they're investing their time, all right? Which is another thing that you can do to get equity in companies, right? You don't have to just write checks. So a scout would be somebody that maybe refers us a deal and says, hey, you got to check this company out. They're great. And advisors are people who really help companies. Okay, so private equity, that's more like a late stage, kind of that Series B and later. You know, they come in, it's all about control, corporate governance, all the sort of really boring stuff. And then you have limited partners, who are the people who actually invest in funds and VCs. Okay, so just real quick on the accredited versus non-accredited. A lot of people have questions about this. So basically, what you have to do in America is such a scam. You know, you can go into any casino in the country, you can lose your life savings on a hand of blackjack, but God forbid that you invest in an early stage Bitcoin company, and that should really be a crime, in my opinion. Okay, so they say you got to make $200K a year, or have $1 million as your net worth, excluding your residence. They give you a free pass if you have a Series 7, 65, or some of these other FINRA licenses. Some family offices get a free ride. You don't have to be accredited, or they give you the accreditation. If you're a knowledgeable employee at certain investment funds, that doesn't even make sense, but that is the actual language, is if you're a knowledgeable employee at a certain investment funds, you can invest in everything. And if you don't meet that criteria, the government allows you to invest in these things. That's real estate, peer-to-peer lending, precious metals. You know, they let you invest in wine, like sort of terrible investments, right? Like I'm gonna buy a thing of wine. Aged drinks, artwork, collectibles, crowdfunding stuff, and Bitcoin, of course, right? So what does it mean to be accredited? What it really means is to click the right button, okay? Click the right button when it asks you if you're accredited. And I had someone that helped me years ago. I likely wasn't. And I'm glad that I clicked the right button then. That was many years ago, and it doesn't matter now. So if you're a founder, and you just got rolling, you want to raise some capital, where are you going to go? You could go to friends and family. A lot of people do that. You have your friends and family around, and you know, there's a saying, it's friends, family, and fools, because only a fool would invest in their friends and family, especially at this kind of early stage. Friends and family rounds are tough because, you know, the founder doesn't really know much about how to value his company and what's going on yet. And certainly Aunt Mary and Uncle Bob, they don't really know too much, right? So they don't usually end up getting the best deal, and that can make for some awkward Thanksgiving conversations there. Okay, so you can go to the angel investors, right? You can go and maybe get $25K from someone, or $5,000 and start putting together a little round that way. You have the VCs, right? You have people like us that might invest, and you know, some VCs will invest $25,000 just in a founder with an idea. And some will invest maybe 150 or 250 after you have some customers. All right, so we have syndicates. That's my favorite. That's a way that you can get started investing in companies yourself for low amounts of money, right? For vetted deals from people who are doing this full time, okay? And then you have crowdfunding. Crowdfunding, there are some in Asia too. Crowdfunding came in around 2013 with the Jobs Act from Obama. And that was basically allowing for companies to raise up to $5 million from unaccredited investors. So it doesn't matter if you click the right button. You can go on those certain websites and you can invest in companies yourself. Okay, pros and cons. Pros, it's a liquid. Cons, it's a liquid. Okay, that's depending on how you look at it. For me, illiquid is great. Okay, I don't like looking down at, you know, you see the stock app on your phone. Do I buy more? Do I sell half? Do I do this? Do I do that? Once you invest in a private company, that's it. Okay, all you can do is root them on, cheer for them. There is no sell button, except in some rare cases, and maybe we'll chat about that in a second. Okay, another pro, YOLO gains. That's right, you can make a ton of money. These aren't scam coins or anything like that, but outsized returns that you won't find most other places. I was in the music business for about 10 years, and you know, major labels can have a 90% failure rate and still be wildly profitable because the one pop star makes up for all of that. And besides the entertainment industry, that's tough to find. Cons, you can lose it all, certainly. Pros, you have write-offs. Cons, cap gains and KYC. These are completely regulated, real investments, and that's what happens. You have KYC. Pros, you get to see rad shit. That's true. You get to see everything cool that's happening all over. If you're getting outside of Bitcoin, you're talking about flying cars and, you know, vegan tennis shoes and all sorts of things, right? So you get to see everything that people are building all throughout the world. Cons, it can be very addicting, and I know that feeling. Okay, legal and regulated, that is good. Fees are bad. There are some fees here, and we're going to get into that in just a second. And then pros are you can be impactful. You know, you can send an email to an early stage Bitcoin founder. If you were an investor in, say, Neutronpay, and you gave them some product feedback or reported a bug or were involved with them, they would answer your emails, which is really cool. And then the cons, of course, it takes time. It takes time for these investments to mature. All right, so how to play. First off, we have direct investments, okay? Direct investments are when you go to the founder directly, you meet them, you take a look at everything, and you just wire him that money yourself. You're responsible for all your own due diligence and everything that comes along with that. You might have your own lawyer looking over a document, but that's a direct investment. And direct investments have the lowest fees because there's nothing really between you and that founder. Certainly the highest risk because the risk is all on you. Funds, okay, you can be an LP in a fund. You can invest in a fund, maybe the minimum is 100,000, maybe it's 25,000. And then you're trusting these GPs to invest that money for you, and funds have higher fees, right? There's something called carried interest. It's a success fee, some people call it in the world, which is for every dollar back that you're returned above your investment, the VCs get 20%. That's how they make money. Okay, the other thing about funds is it doesn't take up any of your time. You don't have to do really any of the work besides evaluate those fund managers before you invest. Okay, crowdfunding. So all those websites, you know, you can go on there, and Republic and WeFunder, and there's a bunch here in Asia too, and you can invest very small amounts of money and get started with some of these things yourself. The problem with crowdfunding is they're usually terrible deals that you don't really want to be in. Every once in a while there's something good on there though. Okay, secondaries. Now let's say that you're an early employee at a company and you have a life event. Maybe you're getting married or your kid's graduating or whatever is going on, and you were one of the first employees at this big company. What do? Well, you can actually take your shares to a secondary market and they'll find a buyer. And then those shares will go before the company, a right of first refusal, and they'll either approve that or not. And it's a win-win for you, because even if the company doesn't approve that transfer, they have to buy your stock. So when you think about secondaries, they're very thinly traded, but maybe at one of these larger name companies in the Bitcoin space, maybe you were one of the first employees. Maybe you're sitting on, I don't know, $12 million of Blockstream stock, you know, and maybe something's happening in your life and you might need, you know, 500K. You can go ahead and take them to the secondary markets, and that is definitely a way that you can invest as well. Okay, so then we have syndicates. Woo, my favorite. Okay, we have one with Lightning Ventures, and it's a $1,000 minimum. We have anywhere between, you know, maybe 2 to 4 deals at a time. Someone mentioned Fountain earlier today. We actually have a deal for Fountain right now. So how do you get access to investing in Bitcoin companies? You know, this is probably the best way. Until you're starting to see them on the crowdfunding stuff, or maybe you have the 25K minimum to get in some of those direct investments, syndicates can be a lot of fun. And, you know, it doesn't behoove the syndicate to roll out junk, okay? It's not a numbers game. It doesn't do us any good at Lightning Ventures to just crank through 10 terrible deals, because when they don't work out, it's not good. It's not good. And when it doesn't work out, the first thing you think is, who sent me this thing? And I don't want to be the one that you think of in that situation. Okay, what do we got here? High scores. Okay, so this is what we're playing for. All right, let's take a look at a few. Now, it's hard to do with Bitcoin companies because it's still early. SoftBank invested $20 million in Alibaba, and that became $143 billion. Okay, that's insane. All right, and that's what we're playing for here. That's why we do this. Okay, how about Airbnb? If you had the foresight when it seemed like an absolutely ridiculous idea to cut Airbnb a $20K check in their seed round, it would have been $2 billion 10 years later when they IPO'd. Now that's the thing though, it took 10 years, right? But where else are you going to get these kind of returns? Coinbase, I think they actually just sold Bitcoin back then. It was 20 cents to $381. God, I think the stock's like 30 bucks now. Hopefully you got out before that. But that took 7 years. And that's basically a 4,000x return. All right, WhatsApp. You know, what's interesting here about WhatsApp is a $60 million investment became $3 billion. That only took 3 years. Sequoia took that entire B round, by the way. So Uber is another great one, 25,000 in their seed round. That's $100 million. It took 9 years. And then Google's Series B was $12 million in '99, turned into $4.3 billion. So this is why we invest in early stage technology companies. I focus on Bitcoin companies, but all of the whole space. Okay, so the power law. What's the power law? The power law is you're going to fail a lot. A lot of these are going to zero. I hate to say it. You've got like a 40% death rate, okay? A lot of times you'll get back one times your money, or 2 or 3 times your money. But if you're thinking that 75% of these things are not going to be the big winners, then the winners that you have to really be outsized. So that's what the VCs are doing, okay? It's the Babe Ruth effect, okay? They're swinging for the fences, all right? It's not really a mom and pop kind of great restaurant, laundromat, cash flowing business, okay? And you shouldn't be offended if a VC doesn't invest in your company because it doesn't have the possibilities of achieving these type of returns that they need, right? They need these type of returns to give to their LPs, to distribute. They need liquidity. Okay, a lot of people talk about unicorns. I just think this funny. I'd like to think of them as like dragon eggs, you know, little dinosaur babies. And that's what you're looking for when you invest in early stage companies. Okay, and invest in $0 billion companies. Okay, you don't want to invest in something at that later stage. All right, so some general return guidelines here. Pre-seed, maybe they raise $250,000 to $1 million, validate an idea. Maybe that gets you your first customers. Milestone-based financing. Okay, a lot of times people think about that. Oh my God, I have the best idea ever for a company. First thing I got to do is raise $3 million. That's not the way you go about it. You want to build something, bootstrap, and then think about where that gets you. Does it get you your first few customers? Does it get you a couple of key hires? What does that $250K to $1 million, and then where's the next stop? Okay, maybe that's a $3 to $5 million valuation, and maybe that's made up of friends, families, accelerators, few angels, okay? And you know, the world is crazy right now, but I have a 40x kind of multiple here for what you might expect to get, okay? Seed round. You're going to raise $1 to $3 million, and in the good times, that was absolutely insane. But $1 to $3 million on a $4 to $12 million valuation, that's still angels, micro VCs. You might get a few smaller VCs in there, some seed VCs, maybe some scout funds. Sequoia, a lot of these people, they have their own scout funds. Okay, Series A, $3 to $10 million. On a $10 to $30 million valuation, we're just giving ranges here for fun, but just to give you an idea of how these numbers go up, right? Because this is a different kind of NGU technology here. Okay, and that's all VCs. Now, what happens at the Series A? Well, you're probably going to give up a board seat. You're probably going to bring someone on that could be great or might not be so great, right? And I think we can talk about that in just a second. All right, so that's a Series A, B, C, and so on. Letters go up technology. Okay, so this is a slide of some places where you might be able to get some deals if you wanted to get started, because that's what you do. You have to see a lot of deals. That's how you learn. So if you sign up on a bunch of these websites, and you could start looking at everything there is. Whether that's kombucha company somewhere in Canada, or maybe you're in Lightning Ventures and we're sending you Bitcoin deals, or maybe you're on some crowdfunding stuff. Whatever you're doing, you have to look at a bunch of deals in order to become familiar with everything. Okay, so let's go over some of these funding instruments here. So equity. Equity is also referred to as a priced round, and that is the only time that a founder knows exactly how much of the company he's selling, and the investors know exactly how much they're buying. Everything else up here requires another event, a future event that hasn't happened yet. okay? So if you're raising $1 million on a 10 million valuation, it's really easy to kind of do that math. Equity is the most protection for the investors as well. Now, we have convertible debt here, okay? Convertible debt is, well, first off, it's debt, right? So debt has an interest rate, it has a maturity date, convertible debt became really popular in the late 90s when it's very expensive, more expensive to do a priced round. A lot of legal fees, timed closings, whole different ball of wax here. You can fire off some convertible debts very quickly. And it also allows you to kind of have a rolling close where you don't need to kind of have a certain day where all those funds come in. So you can put out some convertible debt. Now, this convertible debt is, of course, senior to common stock. So it's better than a safe note that we're going to get into, right? Because you're next to get paid because it is debt. So Y Combinator came out with a safe note, which stands for Simple Agreement for Future Equity. I think maybe around 2016, maybe. Safe notes came out. So what they did was they took out all the things they didn't like about convertible debt. Well, first off, it's not debt, so let's get rid of that. Then there's no interest rate, there's no maturity date, and you're really not in any better position than anyone else because it's not debt. So what is it? Well, let's say that you want to invest in a company, and the one thing that you can agree on is it's worth somewhere between $0 and $10 million. That's the one thing that you and that founder can agree on, is it's worth somewhere in between there, right? But you don't want to have that valuation discussion. You want to just punt that to the future. And what you have here is you have a cap, okay, and you have a discount, all right? So you have a maximum cap that investment can convert at, okay, in the future, right? What future, right? The future of when this company raises $1 million or more in a qualified financing round in the future, all of these outstanding notes will then convert. So if we're investing in a company that has a $10 million valuation cap on a safe note, and then they raise in the future, their next round, their first price round, usually a Series A, with a $20 million pre-money valuation, your investment converts at that cap, at 10 million, okay? If they raise less, at a less valuation than that 10 million, you're gonna convert for less, with the same provisions and everything else as those investors in that Series A round, okay? Kind of just allows for whatever to happen. And sometimes on those things you can have a discount, which is where, let's just say it comes in under the cap, you'll still get a little bit of a bonus for your investment for being early. I like to fight for discounts, and people like to make fun of me for that. Okay, and then you have tokens and scam coins. We don't do any of those, but that's certainly a way that you can raise money. Okay, these are a few good books to learn. Love them or hate them. The Calacanis book is really good. It's about 150 pages. If that doesn't get you excited about angel investing, I don't know what will. Venture Deals, that's like the Bible. That's a great reference book. And these are some websites where you can track and follow your company. This is called Venture Hacks. You know, everyone knows Crunchbase, or at least most people do. Owler, etc. Because there's a lot of research. All right, let's see. What do we got here? All right, don't write a few big checks into very few deals. That is not what you want to do. That is not a way to do this, especially when you're learning. Okay? Also, don't be the first money in. They call it signaling. Signaling is when other investors are participating in rounds, and a lot of angels look for that, right? If Lightning Labs is investing, and maybe a few other Bitcoin VCs that you respect are investing, that's a good sign, rather than just being the first check-in. Or You know, if you can be the last money into a really oversubscribed deal, even your $1,000 investment while you're learning, that's great. And we're going to talk about that in just a second. Okay, so only follow on with material progress. So you invested in this company at a $10 million valuation, and 8 months go by, they haven't really done great. Okay, they're in the same place, maybe with a little bit of growth, and now they're raising another round. We call those extension rounds. That's not what we look for. We look for like material progress. You know, they have 5 times their revenue, and they're raising at a slightly higher valuation later. That's what we look for. So don't just think because you've invested before, you have to invest again. Okay, so pre-product, pre-revenue, watch out. That's a great way to lose all your money. You know, some VCs have rules where they need they don't invest in pre-revenue companies. That's just what they do. Okay, so biotech, medical devices, drugs, drug developers, great way to lose all your money. Be very careful with those. And then something called an uncapped note is when you raise on a safe note or a convertible debt, and there's no cap. And that's the only thing I 100% don't invest in. Okay, so strategy guide. All right, if you can't decide, the answer is no. That's probably good advice, probably for life, not just with investing. And if it's not hell yes, it's still a no. Okay, valuation matters, which is happening now, right? Because in the great times, it's all about growth, growth, growth. And in times like this right now, it's all about defensibility, profits, okay, and cutting. Invest only in technology. Incentives lead to bad investing. Don't invest in some wine company because they're going to ship you a bunch of wine. I can tell you that one from experience. It's an art, not a science. That's the truth of this when you're coming up with these valuations and things. And assume your investment is lost. It's gone. Just same size investment in each company, especially early on. If you maybe have $10,000 or $15,000 and you want to get going with angel investing, probably $1,000 in 10 deals. Read the updates from the founders. Learn as much as you can, okay? Because those check sizes can always go up in the future. Okay, so speaking of check sizes going up, dude, I'm mad broke. I don't have any money, Muzz, man. How am I going to invest in all these companies? Well, there's something called a checkbook IRA. You can actually set one up with a company called Alto IRA. There's a bunch of them. Maybe you have an old 401k sitting somewhere with, you know, 50, 100,000 bucks in it. You can actually use those funds to get many tax benefits in the future and start deploying out of your own IRAs. So there's a lot of other ways to invest in these companies too, right? Okay, small checks in many deals. We covered it. Last money in oversubscribed rounds. Okay, so let's just say that this company is raising $5 million and, you know, Sequoia's in it and Leonardo DiCaprio and name somebody else, and they're all Will Smith, and everyone in the world is in there, and there's $200,000 left, okay, of this big round. And you're in Lightning Ventures or some syndicate or whatever, and you see that there's $200,000 there in this out, and you can see all of the investors that are in that round. Okay, you are literally the last $1,000 into that deal, and that's what I was doing for a long time. And you'd have to fight to keep me out of that deal, and that's exactly where you want to be, especially when you're learning. Okay, so watch the signaling closely and hit the winners hard. All right, I don't know if you're poker people, but you want to think about it as they're really good cards. You want to see a lot of flops because you can always bet more later. Okay, BlockFi. Learn something every day. I learned about this. I'll share the experience here. I did invest in BlockFi. I know, right? It's what you get for shitcoining. Not only did I lose all of my money, but all the employees lost their money. Okay, so that's equity, common stock. It all went to zero. I'd never been in that situation before where that happens, but you learn something every day. And not only did everyone who had their money in BlockFi lose it, but all the investors lost it, and the employees lost it, and it's a whole big ball of not good. Okay, and that's it. And that's it for me.
Awesome, awesome. I'm sure you guys have some questions, so we'll field some questions, right?
Nah, they don't care about me.
I love VC investing. I think it's fantastic. Let's go. Roland.
Hey, so I'm sure you're familiar with fiat education, fiat healthcare, fiat food. Do you have any thoughts on fiat investing versus Bitcoin investing?
Yeah, so it's hard to use comps, right? But let's take Kraken and let's take Coinbase. And I think it's like October 2014 to 2018, you know, Coinbase appreciated 365x and Bitcoin did a 50x, okay? So, you know, it's not that you don't want Bitcoin, of course, right? I mean, we all want Bitcoin, but, you know, it has to outperform. And if it's not outperforming, I would be wasting my time. I wouldn't be here. I would do something else with my life if I didn't think that. Same thing with Kraken, right? Over a similar time period, maybe 2015 to 2019, Kraken had over a 50x return, and Bitcoin did about a 9x over that time period. So it's hard now with a lot of these companies, right? Like even like a Swan Bitcoin. You know, these are still kind of early, you know. But you know, fiat investing, I mean, I don't know, right? I look at it as ways to complement the HODL position.
Yeah, I guess one part of the question is regarding regulation, and I think, I mean, KYC in some ways it's good to protect you as the investor, right? But if you invest in a company and you push KYC, then maybe that company won't actually work in the Bitcoin space because it will be outcompeted by a different company that Bitcoiners will want to use because it's not KYC'd.
Well, you know, these are real regulated investments, and that's the KYC world. You know, the ICOs, sort of IDOs, all of these nonsense ways that companies are skirting the laws to try and raise money by selling a token. I think that breeds kind of crappy investors. If I was a founder, you know, I can't sell a lot of my investments, most of them. And I don't really want investors who can. I don't want somebody who can just hit the dump button, you know, 8 months later, because I don't think that you know, breeds the right kind of investors. So, I mean, I don't know if we're gonna have KYC-free investing, and if there was, honestly, it's kind of scary. I don't want to lose a private key and lose all of my investments. Like, I don't think that that's a good use case for it. You know, maybe like a cell phone number, you know, so nobody can, you know, SIM swap you or port you. You know, you could lose that if that was like a private key, okay, and then I've just lost the access to that phone number forever. But like, I want to just be able to hit the forget password. Or just re-download some documents, like that works in this case. And with, you know, you get tax write-offs on everything that doesn't work. So hopefully a bunch of them, you make a bunch of money, and what doesn't, it's just going to come off of your winners.
Cool, great, thanks very much.
All right.
We got time for one more question right here, and then we'll move on to the next speaker.
Hi, can you say something about investing using crypto? And also maybe investing in coins?
Investing in coins is terrible. You shouldn't do it. You should only buy Bitcoin and maybe start dabbling with some early stage investing in private companies. I wouldn't do anything with any kind of coin.
Yeah, agreed. All right, well, let's wrap it up there. Let's give Muzz a big round of applause, and we're going to take a 5-minute break. Then actually,